If you own gold or silver bullion, there's something you need to understand right now. And I'm not talking about some clickbait headline or fear-mongering nonsense. I'm talking about a fundamental shift in how governments worldwide are viewing precious metals and what that means for anyone holding physical gold and silver. Let me be crystal clear from the start. There is no new federal law in the United States that restricts your ability to own bullion. But here's what's actually happening, and why it matters more than any single piece of legislation ever could. We're witnessing the largest coordinated movement of gold in modern history. Central banks aren't just buying gold anymore, they're hoarding it. And they're doing it at a pace that should make every bullion owner sit up and pay attention. Think about what that means for a moment. The very institutions that print money, that control interest rates, that tell us inflation is transitory and everything is fine, they're quietly accumulating massive amounts of physical gold. Why would they do that if paper currency was as stable as they claim? Let me walk you through what's really happening, because the mainstream financial media isn't going to tell you this story. They're too busy talking about the latest tech stock or cryptocurrency craze. The World Gold Council just released data showing central banks purchased over 1,000 tons of gold in a single year. That's not a typo. 1,000 tons. To put that in perspective, that's more gold than most countries have in their entire reserves. And this isn't a one-time thing. This is a sustained, deliberate strategy that's been accelerating. China's central bank has been buying gold for 17 consecutive months. Not 1 month. Not 3 months. 17 months in a row. Every single month, they're converting their dollar reserves into physical gold. The People's Bank of China isn't making speculative bets. They're making a strategic decision about the future of global currency. Poland just moved 100 tons of gold back to Warsaw from the Bank of England. They physically transported it. Why would they do that? Because they want it under their direct control. They want to be able to see it, touch it, and know with absolute certainty that it's there. India's central bank added over 100 tons to their reserves. Turkey has been buying aggressively. Singapore, Thailand, the Czech Republic, all accumulating physical gold at unprecedented rates. Now here's where this gets interesting for anyone who owns bullion. When central banks move in unison like this, they're not reacting to current conditions. They're positioning for what they see coming. These institutions have access to economic data and intelligence that you and I will never see. They have teams of analysts, economists, and strategists whose entire job is to protect national wealth, and their unanimous decision is to own more physical gold. But let's talk about what's happening closer to home, because this isn't just an international story. The dynamics in the United States are equally revealing, and they directly impact anyone holding precious metals. The COMEX, the primary exchange where gold and silver futures are traded, has been experiencing something unusual. The amount of physical gold available for delivery has been declining while open interest. The number of contracts that could demand delivery has been rising. That's a squeeze in the making. Here's how this works. Most futures contracts are settled in cash. Traders don't actually want the physical metal. They're speculating on price movements. But when the ratio of paper contracts to physical metal gets too high, and if enough contract holders decide they want actual delivery, the system gets stressed. We saw a preview of this during the pandemic when premiums on physical gold and silver exploded. You could see the spot price on your screen, but try to actually buy physical metal at that price? Good luck. Dealers were charging $5, $8, even $10 over spot for silver eagles. The paper price and the physical price disconnected. That disconnect is a warning sign. It tells you that the paper market, where most price discovery happens, might not reflect the true supply and demand for physical metal. Now, let's address the elephant in the room. Why are we talking about laws and regulations when I just told you there's no new federal restriction on bullion ownership? Because the regulatory environment around precious metals is constantly evolving, and there are aspects of ownership that many people don't fully understand. And more importantly, because the government's relationship with gold has a history that every bullion owner should know. In 1933, President Franklin Roosevelt signed Executive Order 6102, which required Americans to turn in their gold coins, gold bullion, and gold certificates to the Federal Reserve in exchange for paper dollars at a fixed rate of $20.67 per ounce. It wasn't a request, it was mandatory, with criminal penalties for non-compliance. Then, after collecting all that gold, the government revalued it to $35 per ounce through the Gold Reserve Act of 1934. Think about that. They forced citizens to sell at one price, then immediately increased the official price by 69%. That's a massive wealth transfer from private citizens to the government. This wasn't ancient history. This happened less than a century ago. And it remained illegal for Americans to own gold bullion until 1974, when President Gerald Ford signed legislation repealing the ban. Now, am I saying the government is going to confiscate gold again? No. The circumstances today are completely different. We're not on a gold standard. The dollar isn't directly backed by gold. The political and economic landscape has changed dramatically. But here's what hasn't changed. When governments face severe fiscal pressure, when debt levels become unsustainable, when currency devaluation accelerates, they look for ways to protect their own interests. And throughout history, gold has always been part of that equation. So while there's no new confiscation law, and I don't expect one, understanding the regulatory framework around precious metals ownership is crucial. Because there are reporting requirements, tax implications, and legal considerations that can significantly impact your holdings. Let's talk about what you actually need to know if you own bullion. First, there are no federal limits on how much gold or silver you can own. You can own 1 ounce or 1,000 ounces. The government doesn't restrict quantity. You don't need to register your holdings. You don't need permission to buy or sell. However, there are reporting requirements for dealers. When you sell certain quantities of specific products to a dealer, they're required to file a Form 1099-B with the IRS. This isn't new. This has been the law for years. But many bullion owners don't understand the thresholds. For example, if you sell 25 or more ounces of gold in the form of 1 ounce Krugerrands, maple leafs, or Mexican onzas, the dealer must report it. If you sell 1,000 ounces of silver in the form of 1,000 ounce bars or 10 ounce bars totaling 1,000 ounces, that triggers reporting. But here's what's interesting. If you sell 24 ounces of gold eagles, no reporting. If you sell 999 ounces of silver, no reporting. The thresholds are specific, and understanding them gives you flexibility in how you manage your holdings. Now, does this mean you should structure your sales to avoid reporting? That's a personal decision, and you should consult with a tax professional. But you should know that regardless of whether a dealer files a 1099-B, you're still legally required to report capital gains on your tax return. The reporting requirement is about dealer compliance, not about whether you owe taxes. And this brings up a critical point about precious metals taxation that many people get wrong. Gold and silver bullion are classified as collectibles by the IRS. That means when you sell at a profit, you're subject to a maximum capital gains rate of 28%, not the lower 15% or 20% rate that applies to stocks and bonds. That's a significant difference. If you bought gold at $200 an ounce and sell it at $2,000, you have an $800 gain per ounce. At a 28% rate, that's $224 per ounce going to taxes. On 100 ounces, that's $20,400 in taxes. This is why some investors look at alternative structures for holding precious metals. And this is where I want to mention something that might be relevant depending on your situation. If you have $100,000 or more in retirement accounts, there's a strategy that allows you to hold physical gold and silver within an IRA structure, which defers taxes until you take distributions. I put together a free guide that explains how this works, the rules you need to follow, and the pros and cons. It's in the description if you want to check it out. Not everyone's situation calls for this approach, but it's worth understanding as an option. All right, back to the bigger picture, because there's something happening in the precious metals market that goes beyond individual ownership and tax considerations. We're seeing a fundamental shift in how the world views gold as a monetary asset. For decades, gold was dismissed by mainstream economists as a barbarous relic, something that belonged in the past, not in a modern financial system. But that narrative is crumbling. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several other countries that have joined or are seeking to join, are actively working on alternatives to the dollar-dominated financial system. And gold is central to their strategy. Russia has been very explicit about this. After Western sanctions froze their dollar reserves, they accelerated their gold accumulation and started settling trade in alternative currencies. They're not alone. China has been promoting the use of yuan in international trade, backed by their growing gold reserves. Saudi Arabia, a country that has priced oil in dollars for nearly 50 years under the petrodollar agreement, is now accepting yuan for oil sales to China. That's a seismic shift. The petrodollar system has been a cornerstone of dollar dominance since the 1970s. What does this have to do with you owning bullion? Everything. Because as the dollars roll, as the world's reserve currency gets challenged, as more countries diversify away from dollar reserves, the value of hard assets like gold and silver becomes more apparent. Think about it from a central bank's perspective. If you're holding trillions in dollar-denominated assets and you see the U.S. national debt approaching $36 trillion, and you see the Federal Reserve's balance sheet still massively expanded from years of quantitative easing, and you see political dysfunction making fiscal responsibility unlikely, what do? You diversify. You buy gold. You reduce your exposure to any single currency, especially one that's being printed in unprecedented quantities. And here's the thing that most people miss. When central banks buy gold, they're not buying it to sell it next year for a profit. They're buying it as a permanent reserve asset. They're buying it because they believe it will hold value over decades, through currency crises, through political upheaval, through economic cycles. That's very different from a trader buying gold futures hoping to flip them for a quick gain. Central banks are making a statement about the long-term stability of fiat currencies. And that statement is, we need an alternative. Now let's talk about silver for a moment, because while gold gets most of the attention, silver has its own compelling dynamics. Silver is unique because it's both a monetary metal and an industrial metal. It's used in solar panels, electronics, medical applications, and countless industrial processes. Unlike gold, which is primarily held as a store of value, silver gets consumed. The Silver Institute estimates that industrial demand for silver has been exceeding mine supply. That means the market has been drawing down above-ground inventories to meet demand. And with the push toward green energy and electric vehicles, industrial demand for silver is projected to increase significantly. At the same time, silver has historically traded at a gold-to-silver ratio that's much lower than where it is today. Throughout history, the ratio has averaged around 15 to 1. That means 15 ounces of silver would buy you 1 ounce of gold. In recent years, that ratio has been closer to 80 to 1 or even higher. If that ratio were to revert to historical norms, either gold would need to fall significantly or silver would need to rise dramatically. Given the supply and demand dynamics we're seeing, and given central bank behavior around gold, which scenario seems more likely? This is why many precious metals investors hold both gold and silver. Gold for wealth preservation and as a monetary hedge. Silver for its industrial demand story and its potential for price appreciation if the gold-to-silver ratio normalizes. But here's what you need to understand about owning physical bullion, whether it's gold or silver. It's not a get-rich-quick scheme. It's not a speculation on next week's price movement. It's a long-term position in hard assets that have maintained value for thousands of years. When you own physical bullion, you're holding something that has no counterparty risk. It's not a promise to pay. It's not dependent on a company's earnings or a government's solvency. It's a tangible asset that you can hold in your hand. That's increasingly valuable in a world where so much of our wealth exists as digital entries in computer systems. Your bank account is a liability of the bank. Your stocks are claims on corporate earnings. Your bonds are promises of future payment. But physical gold and silver, that's yours. Completely. Unconditionally. This is why storage and security become important considerations. Some people keep their bullion at home in a safe. Others use allocated storage at secure facilities. There are pros and cons to each approach. Home storage gives you immediate access and complete control. But it also means you're responsible for security, and it could be a target if anyone knows you have it. Professional storage provides security and insurance, but you're trusting a third party, and there are ongoing fees. There's no one right answer. It depends on how much you own, your personal security situation, and your comfort level with different options. But it's something you need to think through carefully. And this brings me to a critical point about the precious metals market that every owner should understand. The difference between allocated and unallocated storage. When you have allocated storage, specific bars or coins are assigned to you. They're segregated from other clients' holdings. You own those specific pieces of metal. If you want to take delivery, you get those exact bars or coins. With unallocated storage, you have a claim on a certain amount of metal, but specific bars aren't assigned to you. You're essentially a creditor of the storage facility. In normal times, this works fine. But in a crisis, when everyone wants their metal at once, unallocated claims can become problematic. This matters because many gold and silver investment products, including some ETFs, use unallocated storage. You think you own gold, but what you really own is a share of a fund that has claims on gold. That's not the same as owning physical metal. During the pandemic, we saw this play out in real time. Some gold ETFs had to suspend creation of new shares because they couldn't source enough physical gold to back them. The paper market and the physical market diverged. If you're going to own precious metals, understand exactly what you own. Is it physical metal in your possession? Is it allocated storage where specific bars are yours? Is it unallocated claims? Is it shares of a fund? Each has different risk profiles and different implications in various scenarios. Now, let's address something that comes up frequently. The argument that gold and silver don't pay dividends or interest, so they're inferior investments compared to stocks or bonds. This criticism misses the point entirely. Gold and silver aren't meant to be income-producing assets. They're meant to be wealth preservation assets. They're insurance against currency devaluation, against financial system instability, against the erosion of purchasing power. When you buy fire insurance on your house, you don't complain that it doesn't pay dividends. You buy it because you want protection against a specific risk. Precious metals serve a similar function in a portfolio. And here's something that often gets overlooked. Gold has actually outperformed many traditional investments over certain time periods. From 2000 to 2011, gold went from around $280 an ounce to over $1,900. That's nearly a seven-fold increase. Very few stocks match that performance over the same period. But more importantly, gold tends to perform well during periods when other assets struggle. During the 2008 financial crisis, while stocks were collapsing, gold held its value and then rallied. During periods of high inflation, when bonds lose purchasing power, gold tends to rise. That's the real value of precious metals in a portfolio, diversification and protection during times of stress. And we're heading into a period where that protection might become increasingly important. The global debt situation is unprecedented. Total world debt is over $300 trillion. That's debt that needs to be serviced, rolled over, and eventually repaid. But with what? Governments have three options when debt becomes unsustainable. They can default, they can implement austerity and pay it down, or they can inflate it away by printing money. History shows us which option they typically choose. Inflation is the politically easiest path. It's a hidden tax that most people don't fully understand. When the money supply increases faster than the supply of goods and services, each unit of currency buys less. Your savings lose purchasing power. Your wages don't keep up. But the government's debt burden, which is fixed in nominal terms, becomes easier to manage. This is why central banks have inflation targets. They want a certain amount of inflation. It's a feature, not a bug. But when inflation gets out of control, when it goes from 2% to 5% to 8%, that's when people start looking for alternatives. And that's when gold and silver shine. Because you can't print more gold. You can't create silver out of thin air. The supply is limited by geology and mining economics. That scarcity is what gives precious metals their value as a store of wealth. We saw this play out recently when inflation spiked to levels not seen in 40 years. Gold rallied to new all-time highs. Silver surged. People were scrambling to buy physical metal, and premiums exploded because demand overwhelmed supply. That's a preview of what could happen if inflation becomes entrenched, if currency devaluation accelerates, if confidence in fiat money erodes further. Now, I want to be clear about something. I'm not predicting the collapse of the dollar or the end of the financial system. Those are extreme scenarios that may or may not happen. What I am saying is that the risks are elevated, the warning signs are there, and having some exposure to hard assets is a prudent hedge. How much exposure? That's a personal decision based on your overall financial situation, your risk tolerance, and your investment goals. Some advisors suggest 5 to 10% of a portfolio in precious metals. Others recommend more. There's no magic number. But here's what I would say. If you have zero exposure to physical gold and silver, you're making a bet that fiat currencies will maintain their purchasing power, that governments will manage their debt responsibly, that central banks will successfully navigate the challenges ahead, and that the financial system will remain stable. Maybe that bet pays off. But is it a bet you want to make with 100% of your wealth? The beauty of owning physical bullion is that it's a form of financial insurance that doesn't expire. If the worst-case scenarios don't materialize, you still own a tangible asset that has held value for millennia. You haven't lost anything except the opportunity cost of having that capital in other investments. But if those scenarios do materialize, if we see currency crises, if we see financial instability, if we see the kind of monetary chaos that has occurred repeatedly throughout history, then that physical metal could be the difference between preserving your wealth and watching it evaporate. Let me share a historical example that illustrates this point. In Weimar Germany in the early 1920s, hyperinflation destroyed the value of the German mark. People who held their wealth in paper currency saw their life savings become worthless. A loaf of bread that cost a few marks in 1921 cost billions of marks by 1923. But people who owned gold? They preserved their wealth. They could exchange gold for goods and services. They could wait out the crisis and emerge with their purchasing power intact. This isn't ancient history. This is what happens when governments lose control of their currencies. It happened in Germany. It happened in Zimbabwe. It happened in Venezuela. It's happening in Argentina right now. And while the United States is not Weimar Germany, while we're not Zimbabwe or Venezuela, the fundamental dynamics of currency debasement are the same. Print too much money, and it loses value. It's not a matter of if, it's a matter of degree and timing. This is why central banks own gold. This is why wealthy families have owned gold for generations. This is why gold has been money for 5,000 years. Because it works. Because it preserves wealth across time and across crises. Silver has a similar history, though it's been more volatile due to its smaller market size and its industrial uses. But the principle is the same. It's a hard asset with intrinsic value that can't be debased by government decree. Now, let's talk about something practical. How to actually buy and store bullion if you decide it's right for you. First, buy from reputable dealers. There are many legitimate dealers, both online and brick and mortar. Check their ratings, read reviews, verify their established businesses. The precious metals industry has its share of scams and overpriced products, so do your homework. Second, understand what you're buying. Gold and silver come in various forms: coins, bars, rounds. Government-minted coins like American Eagles, Canadian Maple Leafs, and South African Krugerrands typically carry higher premiums, but are more widely recognized and easier to sell. Bars and rounds usually have lower premiums, but may be less liquid. Third, pay attention to premiums over spot price. The spot price is what gold or silver trades for on the commodities exchanges. The premium is what dealers charge above that price to cover their costs and profit. Premiums vary based on product type, market conditions, and dealer. Shop around. Fourth, consider your storage options carefully. If you're keeping it at home, invest in a good safe. If you're using professional storage, understand the terms, the insurance coverage, and the fees. Make sure you know exactly what you own and where it is. Fifth, think about your exit strategy. At some point, you may want to sell. Know how you'll do that, what the tax implications are, and what the market conditions might be. Don't wait until you need to sell to figure this out. And here's something that often gets overlooked: estate planning. If you own physical bullion, make sure your heirs know about it and know how to access it. There are stories of people who hid gold so well that it was never found after they passed away. Don't let your wealth disappear because of poor planning. The precious metals market is also evolving with technology. There are now platforms that allow you to buy fractional amounts of gold and silver, stored in allocated accounts, with the ability to take physical delivery if you want. This makes precious metals accessible to people who might not have thousands of dollars to invest in full ounces. There are also blockchain-based gold tokens, where each token represents ownership of physical gold stored in vaults. These combine the benefits of physical gold ownership with the convenience of digital transactions. It's an interesting development, though it introduces technology risk and counterparty risk that pure physical ownership doesn't have. The key is to understand what you're getting into, to do your research, and to make informed decisions based on your specific situation. Now, as we wrap up, I want to come back to the title of this video. If you own bullion, a new law just passed. The truth is, there's no single new law that changes everything. But there is a changing landscape, a shifting global monetary order, a growing recognition that the post-World War II financial system is under stress. Central banks are voting with their actions. They're buying gold at record rates. They're repatriating their gold from foreign vaults. They're reducing their dollar exposure. These are not random decisions. These are strategic moves by institutions that understand what's coming. As a bullion owner, you're positioned for this shift. You own an asset that has survived every currency crisis, every empire's collapse, every financial panic in human history. That's not hyperbole. That's historical fact. But you need to understand the rules, the regulations, the tax implications, and the practical considerations of ownership. You need to know what reporting requirements exist, even if they don't restrict your ability to own metal. You need to think about storage, security, and estate planning. Most importantly, you need to understand why you own precious metals. If you're treating it as a short-term speculation, you're probably going to be disappointed. The price can be volatile. It can go sideways for years. It doesn't pay dividends or interest. But if you own it as a long-term store of value, as insurance against monetary instability, as a hedge against currency devaluation, then you're using it for its intended purpose. And in that context, the day-to-day price fluctuations matter less than the fundamental role it plays in your overall financial strategy. The world is changing. The monetary system is evolving. The risks are real, but so are the opportunities for those who understand what's happening and position themselves accordingly.